Welcome to Mathematical Finance. Imagine you want to buy a ticket to a highly anticipated concert next month, and you find a special pass that gives you the right to buy the ticket for a fixed price of $50. If the band goes viral, that pass becomes incredibly valuable. This is exactly how financial options work in the stock market. And today, we will uncover the 6 mathematical factors that determine their exact price. Now that we understand the basic idea of an option, let us look at what drives its value. In mathematical finance, an option's price is not a random guess. It is a strict mathematical result driven by 6 fundamental variables. These are the current stock price, the locked-in strike price, the time remaining until expiration, the volatility or price swings, the risk-free interest rate, and any expected dividends. Understanding how each factor influences the price is the absolute foundation of all pricing models, including the famous Black-Scholes model. Let us first look at the most obvious factors, the current stock price and the strike price. A call option gives you the right to buy the stock at a fixed strike price. If the current stock price goes up, buying it at that lower fixed price becomes much more valuable. Conversely, a put option gives you the right to sell. If the stock price drops, selling it at a higher fixed price is highly profitable. Therefore, call prices move in the same direction as the stock price, while put prices move in the opposite direction. To express this relationship mathematically, we use partial derivatives. This expression states that the partial derivative of the call option price with respect to the current stock price is strictly greater than 0. In plain English, this means that as the stock price increases, the price of the call option must also increase. The positive sign indicates a direct, upward relationship between the two variables. If you hold a call option, you are actively hoping for the stock price to rise so your contract gains value. This fundamental mathematical property is why call options are so popular during bull markets. On the flip side, we have the put option. Here, the partial derivative of the put option price with respect to the stock price is less than 0. This tells us that as the stock price goes up, the value of the put option goes down. The negative sign represents an inverse relationship, which makes perfect logical sense. The right to sell something at a fixed low price is completely useless if the actual market price is soaring higher. Therefore, put options act as a form of insurance against falling prices. Before we look at a concrete example, we need the formula for the intrinsic value of a call option. The intrinsic value is the immediate guaranteed profit if the option expired right now. In this equation, V represents the intrinsic value. The max function simply tells us to choose the larger of the two numbers inside the parentheses. The first number is the profit from exercising and the second number is 0. If the difference is negative, we choose 0 because an option holder would simply walk away rather than lose money. Now that we have our formula, let us see it in action. Suppose a stock is currently trading at $50 and you hold a call option with a strike price of $45. We substitute these values into our formula to find the exact state of the market right now. The subtraction reveals a potential gross profit of $5. This means if the option expired today, you could buy the stock for $45 and immediately sell it in the open market for $50, pocketing a guaranteed $5 profit. Continuing with our example, let us simulate a sudden upward jump in the market. We substitute the new, higher stock price of $55 into the exact same formula, keeping the strike price strictly fixed at $45 because the contract terms never change. The new intrinsic value becomes $10. By increasing the stock price factor while holding all other factors constant, the value of the call option doubled. This perfectly demonstrates why a higher stock price directly translates to a larger guaranteed profit for the call holder. To visualize what we just calculated, let us look at this graph. The horizontal axis represents the current stock price, and the vertical axis is the option premium. The vertical dotted line marks our fixed strike price. Notice the solid blue curve for the call option? As the stock price moves to the right, the call premium rises, just as we saw in our example. Conversely, the dashed red curve for the put option falls as the stock price increases. This diagram beautifully captures the opposing directional shifts of calls and puts. Moving on from stock price, we consider time to expiration and volatility. Time is money in the options market. More time means more opportunities for the stock price to move in a direction that makes you rich. Therefore, increasing time generally increases the price of both calls and puts. Volatility measures the uncertainty or the size of the price swings. Because your downside is strictly limited to what you paid for the option, larger price swings increase the chances of a massive payout without increasing your maximum possible loss. This brings us to the mathematical relationship for volatility. This formula shows that the partial derivative of the call price with respect to volatility is positive. The same holds true for put options. In simple terms, higher volatility always makes options more expensive, regardless of whether they are calls or puts. If a stock is completely flat and never moves, an option is highly unlikely to suddenly become profitable, so it is cheap. But if the stock is jumping wildly, the option acts like a lottery ticket with a high chance of winning, so it costs more. Finally, we have the risk-free interest rate and dividends. When you buy a call option, you are delaying the payment of the strike price until the expiration date. If interest rates are high, the money you hold on to can earn a lot of interest in the bank in the meantime. This makes the delayed payment cheaper in today's terms, increasing the call option's value. Dividends have the opposite effect. When a company pays a dividend, its stock price drops by that exact amount, which hurts call options but heavily benefits put options. To understand the interest rate effect, we use the continuous compounding formula to find the present value of the strike price. Here, P is the present value, K is the strike price, R is the risk-free interest rate, and T is the time to expiration in years. The negative sign in the exponent pulls the future value backward in time to today. This tells us exactly how much cash we need right now to meet our future obligation. A lower present value makes the effective cost of buying the stock cheaper, making the call option more valuable today. Let us see this with a concrete example. A trader is evaluating a call option with a strike price of $100, expiring in exactly 1 year. The current interest rate is 2%. We substitute these values into our continuous discounting formula to set up our baseline scenario. Simplifying the exponent, we find the initial present value is 98.02. This means you only need to set aside $98.02 today to pay the $100 strike price next year. Now, suppose the central bank suddenly raises the interest rate to 5%. We substitute this new, higher rate into the formula, keeping the strike price and time exactly the same to isolate the effect. The exponent is now a larger negative number, which results in a smaller final value. The new present value drops to 95.12. Because the interest rate increased, your effective cost to buy the stock went down, proving mathematically why higher interest rates increase call option prices. We have covered the full topic of factors affecting option prices. To summarize, the price of any option is a delicate balancing act between 6 forces. Remember that calls and puts often react in opposite directions to changes in stock price, strike price, interest rates, and dividends. However, they both universally benefit from more time to expiration and higher volatility. Understanding these interactions is essential for anyone trading in the financial markets to price options fairly and avoid losing money to arbitrage.